The MACD is one of the most popular momentum indicators among retail traders. Here I'll explain what the MACD is and how you can save screen time by programming a MACD divergence strategy for the pound-yen. Developed by Gerald Apple in the 1970s, the MACD measures momentum by plotting the difference between two EMAs. It consists of two lines, the main line and the signal line. The main line is simply the difference between a 12 and 26 period EMA. Notice that the main line crosses under 0 when the 12 period EMA crosses under the 26 period EMA. The MACD signal line is a 9 period simple moving average of the main line. The difference between the MACD main line and signal line is usually plotted as a histogram. The MACD is primarily used to detect short-term momentum. When there is an upside move, the 12 period EMA reacts faster than a 26 period EMA. This causes the two EMAs to diverge and the MACD main line increases. The MACD is great at visually quantifying the momentum of these moves. Here are the two most common ways to use the MACD to generate entries. First, we have the zero line crossover. When the MACD main line crosses above 0, momentum is bullish and a long trade can be opened. Next, we have the signal line crossover. Long trades are opened when the main line crosses above the signal line. Compared to the zero line crossover, signal line crossovers generally produce more signals at the expense of accuracy. Both of these entry signals have been backtested extensively, so let's try a divergence strategy instead. Momentum divergence occurs when price and momentum move in opposite directions. There are two types of divergence, regular and hidden. A regular divergence indicates momentum is leaving the trend. It usually occurs towards the end of long trends. For example, during a downtrend, a regular bullish divergence occurs when prices make a lower low, but the MACD makes a higher low. This signals a possible trend reversal. Now for hidden divergences. A hidden divergence indicates momentum entering the trend. It usually occurs towards the end of long consolidations. For example, during an uptrend, a hidden bullish divergence occurs when prices make a higher low, but the MACD makes a lower low. This signals possible trend continuation. Note that real price action is never as clean as the textbook diagrams above. Here we have a bullish hidden divergence between prices and the MACD main line. Unfortunately, momentum divergences do not happen all that often, and I'm not a big fan of staring at my screen waiting for one. So I'll program a strategy that detects divergences. Since I mostly trade trend-following strategies, I'll focus on using hidden divergences to predict trend continuation. I want to trade in the direction of the long-term trend and use the MACD to time my entries. The challenge lies in programming the swing highs and lows that form the basis of divergence. How do you objectively define a swing? These are three types of swing highs which are obvious to the human eye, but will likely require different programming rules. It's easy to end up with a whole bunch of rules when attempting to program a swing. To circumvent this, I'll consider divergence to be present whenever price and momentum move in opposite directions. The presence of a swing will not be relevant. I will use the following simplified logic for price and the MACD main line. A bullish hidden divergence is present when the most recent low is above the highest low of the previous 10 periods, and the most recent MACD value is below the lowest MACD value of the previous 10 periods. Similarly, a bearish hidden divergence is present when the most recent high is below the lowest high of the previous 10 periods, and the most recent MACD value is above the highest MACD value of the previous 10 periods. Now for some AlgoWizard action. Here are the divergence entry conditions for the long side. The indicator highest function returns the highest price or indicator value over the lookback period, while the indicator lowest returns the lowest value. 0 means the highest value will be returned. Using 1 will return the second highest value, and so on. Divergence period is the lookback period and will be set to 10. The bar shift 2 refers to the second most recently completed bar. The 10 bar lookback period starts from this bar. If you mistakenly set the bar shift of 1 here, this condition will never be satisfied because the left-hand side uses the most recently completed bar. In general, using momentum indicators in isolation will create a whole bunch of false entries, so let me add a long-term trend filter. The strategy will only go long when prices close above the 20-period EMA and the 20-period EMA is above the 50-period EMA. Here's a long entry. How about trade management? Most of the trend following strategies on this channel only use a trailing stop for trade management. Such minimalism is intentional because I want to ride the trend until it reverses. Of course, the flip side is that I may lose a chunk of open profits if the market reverses sharply. Other trade management methods may be preferable if you want to minimize your time in the market, or if you want to reduce correlations with other trend following strategies in your portfolio. I will experiment with the following for this strategy: a 70 pip catastrophic stop loss, a 30 pip break-even stop loss, a 150 bar time stop, which corresponds to about 3 days on the 30-minute time frame, and I will exit my trades on Friday at 3 p.m. New York time. Momentum divergences don't occur that often, so I will max out my backtest period to about 18.5 years. We have a healthy sample of about 900 trades here. There is some stagnation towards the end of the backtest, which the strategy has recently recovered from. You may obtain better results with some careful parameter optimizations or by trading on a different market. So there you have it, an automated MACD divergence strategy that helps you ride the trends without investing too much screen time. If you want, you can refine the strategy by programming in the actual swing highs and lows. I think this will improve the win rate at the expense of trading frequency. Stay tuned for more trading strategies and don't forget to like, comment, and subscribe.